Good afternoon, everyone. My name is Sarah Barker, and today I am incredibly excited for the highly informative presentation that we have from Kullman Accounting and Frost Law. Today's topic is accounting, finance, and tax resources for senior care companies. This is such a hot topic and so important to the success of whatever type of senior service related company that you have, or if you're considering starting one. So very fortunate to have these professionals with us today. And starting off is Joe Campbell, CPA, who will be talking about outsourced CFO services. Thank you, Joe.
Thanks, Sarah. Okay, can everybody see this?
Yes.
Okay, so as Sarah mentioned, my name's Joe Campbell, CPA. I am the Director of Outsourced CFO Services at Kullman Accounting. And here with me is my colleague, Jody Waltrip, who is the Manager of Tax at our sister office, Kullman CPA, and Matt Edelman of Frost Law. So with Kullman Accounting, we offer home care industry focused fractional CFO services. And fractional just means part time. Fractional CFO services are a customizable expansion of outsourced bookkeeping and strategic advising services through the use of experienced finance professionals that are scalable and flexible to match the needs and budget of your company. The benefits of outsourcing are it's flexible. You can use us on a part-time basis. It's challenging to go out and hire someone on a part-time basis that's going to have the accounting and industry experience that would match the 9 years of experience that I have myself in home care. And through the use of Kullman Accounting, you're able to use tried and true industry experts. It's affordable. It's significantly less than hiring a W-2'd employee or a full-time employee. A W-2'd employee would require you to pay payroll taxes, which are about 18% on top of their base pay. You can avoid benefits like health and dental insurance, 401k, workers' comp, etc. And you can avoid time off, such as vacation, sick, or maternity leave. Which brings me to my last bullet point, which is that we are reliable. You don't have to worry about us calling off or not having the basic experience or familiarity with your industry that you would expect. Some of the key services that we offer are we work directly with your management team. We help develop and update a weekly dashboard that's customized to your business. We develop and update a weekly lost hours report, a weekly sales report, and a weekly cash management report. We also work closely with ownership and management to develop a break-even and a budget, which includes a monthly budget to actual report. We also help with performing a finance department checkup. I'm now going to go into some of these sample reports and just give you an overview of what they do. Through my years of experience in the home care industry, I've helped to create these reports that give owners insight that can help them grow and maximize their businesses. The first thing that we start with is developing your weekly goals. So I work with the owners to develop their goals, and we look at where they're currently at and where they want to be, and we help set realistic targets. And then each week, we enter in these items that we develop together. And these here that you see are just an example. And what this shows you is each week where you stack up against your goals. So some of the things that I put in here were the percentage of your break even goal that you reached, your average bill rate, your gross margin, total hours, total clients, change in hours, change in clients, and client turnover, and average hours per client. Some other things that my clients like to put in here are some caregiver stats, like the number of caregivers that worked that week, the utilization, their turnover, the average hours worked per caregiver. We also help prepare and distribute this lost hours report. This will show you where your clients stacked up against the previous week's billing. So this will show you the prior week, the current week, the change in hours, and it'll also show you the prior week and current week revenues and then the change in revenues. Some clients prefer to have this sorted by hours, others prefer to sort it by revenues, and we send it out to your management team for them to put comments in here as to why the revenues went up or down. And then you can look at this and review this for insight into trends within your client base. The sales report is different from the dashboard in that it'll give you a cross-sectional view into your company. And it basically breaks down your total sales by your client segment. And it shows you the number of clients within each segment, the hours and overtime hours for those clients, the revenues, and the average bill rates. And it also gives you a percentage of each one of those segments to the total client population. This also shows you a change week over week for each week that it's updated, and it gives you a margin analysis on the current week. So this will show you which client segments are the most profitable, which ones had the most unbilled OT, and it shows you the average pay rate within each one of those client segments as well. This will also show you the average hours per client, the average gross profit per client, and then we also help you determine a cost to that unbilled overtime, which is a kind of a hot point of to focus on for a lot of the home care agencies because it's one of the biggest losses of margin. And let's see, the cash management report shows a projection of cash for the current week and the following week. It also factors in estimates of collections through the week, large recurring items that are due to come out, and any open invoices that you have in QuickBooks. And this is more of an interactive report in that we update this based on QuickBooks and our knowledge, and then we send it to the owner for the owner to review and mark which invoices or bills they want to pay. And then we are able to update it from there and help give guidance in how the cash should be managed. And the other service that I mentioned was a finance department checkup. And in this, we find ways to streamline your business. And the areas that we like to focus on are ways to simplify, ways to automate, and ways to integrate. So simplification is related to things like your pricing, your offerings, your processes. Automation is focused on using software to help keep track of items like mileage and overtime and holidays. I've actually, going into work with new clients, I have actually seen a lot of them do things manually. They're using paper timesheets and they're tracking things like mileage and overtime outside of their actual timekeeping system. So utilizing that software and automating those things can really save a lot of time. And integration is utilizing software integrations to avoid manual entry. one of the biggest areas I see this is payroll. So you want to be able to export all your time entries and then import them into your payroll provider instead of using paper timesheets or um, things like that. And having your payroll provider integrate with your 401k is another big one instead of having to calculate those manually. So all of these things really result in more efficiency and more accuracy because manual entry can really just open up a door for all kinds of errors. So these are the three biggest areas that we like to look at. And some of the supplementary services that we offer are tax and consulting services, which Jody is about to touch on, and software assessments. So we look for solutions to your current processes and how softwares can support those. And we can perform implementations and assistance with setup of those softwares, conversions from existing softwares, and tune-ups to make sure that you're using your software to the fullest capacity. We also can perform with to help with connecting your bank and third-party apps to QuickBooks, integrating existing software with payroll providers, cloud storage solutions, and converting from QuickBooks Desktop to QuickBooks Online. So in summary, by utilizing an outsourced CFO, you're able to tap into direct industry experience, reports and templates that are based on the extensive knowledge that we have in your business and your industry, a dedicated team of experts, and Kullman Accounting brings over 30 years of experience in industry-wide tax, accounting, and advisory services. I'm going to leave my contact info up here before I turn the presentation over to Jody. And okay, Jody, I'm going to pass it over to you now.
Okay, great. Thank you, Joe. Hi, everyone. As Joe mentioned, my name is Jody, and I'm a CPA and a tax manager at Kullman CPA LLC. Our main office is located in Annapolis, Maryland. We provide a wide range of services, including tax preparation, consulting, and assurance services such as audits, reviews, and compilations. Today, I am going to briefly discuss meals and entertainment, local travel, cell phones, and Section 199A. This is only meant to be general information, so please consult with your tax advisor on any of these. And a little funny joke that I like to always say is that your tax advisor likes to use these terms a lot generally, and it depends. Everybody kind of gets a kick out of that. All right, so first up is meals and entertainment. Prior to 2018, meals and entertainment were generally 50% deductible. And of course, there were some exceptions, such as if you had a party for your employees, like an annual holiday party, those were still 100% deductible. But under the Tax Cuts and Jobs Act of 2017, which we usually refer to as TCJA, all of that changed. And so the TCJA is effective for years 2018 through 2025. And during this time, one of the major changes was that entertainment is no longer deductible. The business meals continue to be 50% deductible. And the same rules that existed prior to TCJA, they are still in place, such as the meal has to be for a business purpose, and either the taxpayer or an employee needs to be present. And the meal can't be extravagant. Now, recently, due to the pandemic, the rules for restaurant meals changed. And so for calendar years 2021 and 2022, business meals purchased from restaurants are 100% deductible. And restaurants include businesses that prepare and sell food or beverages to retail customers for immediate on-premises or off off-premises consumption. So for this purpose, places like grocery stores and convenience stores and other businesses that primarily sell prepackaged goods, not for immediate consumption, do not qualify as restaurants. And then therefore that would still fall under the 50% deductibility. Next up is local travel. So local transportation expenses are the ordinary and necessary expenses of getting from one workplace to another when traveling within the taxpayer's home area in the course of business. So these expenses include the cost of travel by air, rail, bus, taxi, etc., and the cost of driving and maintaining an automobile, which includes depreciation. The most important feature of the local transportation rules is that your commuting costs aren't deductible. So the fare that you pay or the miles you drive simply to get to work and home again are considered personal, not business miles, and no deduction is available. And this is true even if work is performed during the trip, for example, through the use of a cell phone or if a business meeting is held in the car during the trip. However, once you get to the work location, the cost of any local trips you take for business purposes is a deductible business expense. So if you have two business locations, the cost of travel between them is deductible. Now you should always keep receipts if you take a trip, via taxi or public transportation, or if you're driving, keep a mileage log, whether it's a business or a personal vehicle. And when keeping a mileage log, make sure you record the date, the amount spent or the miles driven, the destination, and what is the business purpose. And be sure to also include tolls paid or parking fees and keep the receipts. And a credit card statement is not a receipt. Under TCJA, the miscellaneous itemized deductions are disallowed. So therefore, the deduction of unreimbursed local transportation expenses of employees, they're lost. But please note that the employers can reimburse the employees through an accountable plan when the employee submits an expense reimbursement form. The local transportation expenses of self-employed taxpayers continue to be deductible as ordinary and necessary business expenses. So that is good news for the self-employed. And you'll need to allocate your automobile expenses between business and personal use based on the miles driven during the year. So proper record keeping is crucial in the event of an IRS challenge. There are two ways to deduct the automobile expenses. First is using the standard mileage rate, which between January 1st, 2022 and June 30th, 2022 was 58.5 cents. But after June 30th, it increased to 62.5 cents, and that's per mile. And then you also do get any expenses for tolls and parking. Or the second method is using the actual expenses, which includes depreciation for the portion of the car use allocable to the business. For the second method, you will need to keep track of all costs for gas, repairs and maintenance, insurance, interest on a car loan, tires, oil changes, and any other car-related costs. Our third topic is cell phones. When an employer requires employees, primarily for non-compensatory business reasons, to use their personal cell phone for business purposes, the employer's reimbursement of the employee's expenses for reasonable cell phone coverage may be treated as non-taxable. This favorable tax-free treatment is available without the need for the burdensome record-keeping requirements. However, this treatment doesn't apply to the provision of cell phones or reimbursement for cell phone use that aren't primarily business related, as this type of arrangement is generally taxable. Also, this tax treatment doesn't apply to reimbursements of unusual or excessive expenses or to reimbursements that are a substitute for a portion of the employee's regular wages. A number of employers provide their employees with cell phones primarily as non-compensatory equipment for use in the employer's business. The value of the business use of employer-provided cell phones is excludable from the employee's gross income as what we call a working condition fringe benefit, to the extent that if the employees had paid for the use of the phones themselves, the payment for that use would have been deductible by the employee as a business expense. The employer will be treated as having provided the employee with a cell phone primarily for non-compensatory purposes if there are substantial business-related reasons for provision of the cell phone. And some examples of non-compensatory purposes include the need to be accessible to the employer at any time for work-related emergencies, or to be accessible to customers outside of normal business hours or when away from the office. If the primary purpose requirement is met, the value of any personal use of the employer-provided cell phones will be treated as a non-taxable de minimis fringe benefit. An employer-provided cell phone is not provided primarily for non-compensatory business purposes and results in taxable income if the phone is provided as a substitute for compensation to attract new employees or to promote employee morale. And our final topic is Section 199A. Hopefully, you've all heard about Section 199A, which was introduced as a new provision under TCJA. Under Section 199A, non-corporate taxpayers may claim a deduction of 20% of qualified business income, or QBI. So S corporations, partnerships, multi-member LLCs, and Schedule Cs may qualify. This is a free deduction if the certain thresholds are met. So if you haven't heard about it, I highly recommend consulting a tax advisor. The motivation behind Section 199 is clear, and that is to allow these business owners of these S Corps, partnerships, and Schedule Cs to keep pace with the significant corporate tax cut also provided under TCJA, which we know is the corporate tax flat rate of 21%. For purposes of the pass-through deduction, a taxpayer's QBI for a tax year is the net amount of the taxpayer's qualified items of income, gain, deduction, and loss relating to any qualified trade or business. The items of income, gain, deduction, and loss are qualified to the extent that they're effectively connected with the conduct of a trade or business within the United States, and they're included or allowed in determining taxable income for the tax year. The calculation, even though it kind of seems easy on the surface, can get pretty complicated. And since I only got 10 minutes, I can't go into a lot of the special rules. But the basics are the QBID, which is the qualified business income deduction, is the lesser of 20% of the qualified business income that is either passing through to an individual on a K1, or is the net Schedule C income after being reduced by separately stated items such as the deductible portion of self-employment tax, self-employed health insurance deduction, and the deduction for qualified plan contributions, which include defined benefit plans and profit sharing, et cetera. Or all of that was one thing, or 20% of the individual's taxable income. If certain other limits apply, then the QBID limitation also includes 50% of the qualified W-2 wages, or if you don't have wages, 25% of the qualified W-2 wages plus 2.5% of the unadjusted basis of qualified property. If the pass-through entity doesn't provide the information to the shareholder, the partner, or the member regarding QBI on his K1, then no deduction is allowed. And remember, since this is a free deduction, we have had clients who received a K1 without the 199 information on it, and we had to get those tax returns amended to get our clients those deductions. Here is a sample of what it will look like when it comes through on a K1. On an S Corp, it comes through on line 17 with a code V. And then for a partnership or a multi-member LLC, it goes on line 20 with a code Z. And then you also get the supplemental information that shows you the ordinary business income, the W-2 wages, and the unadjusted basis of qualified property. And Section 199A is set to expire in tax years beginning after December 31st, 2025, along with most of the other TCJA provisions, unless they get extended, which sometimes happens. So thank you so much. This concludes my portion of the presentation, and I am now going to turn the presentation over to Matt Edelman, a trusted advisor from Frost Law, and Matt will be discussing the employee retention credit.
Thank you, Jody. Excuse me while I figure out how to use a computer again. Anyhow, I'm here to talk to you guys about the employee retention credit. I'm going to try to keep this brief, as I know this is not the most interesting piece of presentation material, but this is a pretty cool thing to hear about when there is a chance to get a really, really significant income tax refund by filing an employee retention credit claim with the IRS. Apologize. I'm still having a little trouble figuring out how to share my screen correctly. Give me just one moment if you don't mind. And it's still not quite working correctly. Let's see.
Matt, that's okay. If you would like, I can go ahead and click through the slides.
Yeah, that'd be great. If you can go ahead and skip down to what is the employee retention credit, please. We'll skip past the legalese. So what is the employee retention credit? The employee retention credit was a credit that came into existence as part of the CARES Act, one of the first big pieces of relief legislation passed in the early pandemic in the early parts of 2020. And this piece of legislation was meant to deliver relief to businesses around the country that were struggling because of the shocks to the economy during the pandemic. The employee retention credit delivers a refundable tax credit to businesses that kept employees on payroll during the pandemic as a reward for basically keeping the economy going. You can go ahead and skip the next slide, Sarah. So the employee retention credit, as I mentioned, was created as part of the CARES Act in 2020. The CARES Act also brought into existence the PPP loan program, which I'm sure everybody here has heard about. Not everybody has heard about the employee retention credit, unfortunately. It's unfortunate because that has delivered some really significant relief to a lot of business owners that weren't initially aware of it. The employee retention credit can deliver a refundable tax credit of up to $5,000 per employee during 2020 and as much as $7,000 per employee per quarter during 2021 for the first 3 quarters of 2021, which would deliver a maximum potential credit of $26,000 per W-2 employee that the business kept on payroll during the pandemic. If you go to the next slide, Sarah. So the one thing that I do need to mention is, like I said, the ERC and the PPP program came into existence at the same time. However, when this was first written into law, the CARES Act said that businesses could either choose the ERC or they could choose to get a PPP loan, but they could not do both. That all changed with the passage of the Relief Act in late 2020, with which Congress said, you know what, if you got a PPP loan, you can actually go back and get the ERC even retroactively. You can get both a claim for the ERC as well as a PPP loan. The one stipulation, though, when they allowed businesses to get both the PPP loan and the ERC is that you can't double dip. What that means is that you can't claim the employee retention credit on wages that were paid with a forgiven PPP loan. Go ahead and skip to the next, Sarah. So who qualifies for the employee retention credit? There are 3 main ways that a business can qualify for the employee retention credit, and I'll go through these one by one. Go ahead and skip to the next slide. So the first one, I won't get into this one too much because this one is pretty black and white. The first way a business can qualify for the ERC is having shown a sharp decline in revenue during the pandemic. This is defined as a 50% drop in gross receipts during 2020 or a 20% drop in gross receipts during 2021. However, again, that's pretty black and white. That's a simple calculation and something that many business owners can do on their own. What I'm here to tell you about is the next slide here. The next way that a business can qualify for the employee retention credit, and that is through what the IRS terms a suspension of operations. A business that during the pandemic had their operations fully or partially suspended due to a government order or restriction can qualify for the employee retention credit. Now, these government orders that would have restricted the business, I'll give you an example. So for the home care industry, most of the listeners to this presentation were likely prevented from sending their representatives into assisted care facilities or hospitals, for example. So they were prevented from being able to go out and market the services of the business. This would be an example of how a government order created a partial suspension of this business's operations. What this means is the business doesn't have to have been entirely shut down. You didn't have to shut your doors to qualify for the credit. You just have to show that your business's operations were impacted by this government order. And I'm going to emphasize this line at the bottom here one more time. A lot of business owners think that because their business was not completely shut down, that they are not eligible for the ERC, and that is not necessarily the case. Let's go ahead and go to the next slide, and I'll talk to you real quick about how a business shows that they were subject to a suspension of operations. In order to demonstrate that a business was experienced a suspension of operations, the business has to show that either it had a more than nominal portion of its revenue impacted by a government order. What this means is that if a business can show that a government order impacted what would have represented 10% of the business's gross receipts during 2019, it would have experienced a partial suspension of operations. I'll use a restaurant as an example here because that is a pretty easy one to demonstrate. Many restaurants around the country had a government order that made it so that they could either not open their dining room or they could only fill a certain number of tables in their dining room. So let's use again, if that business gleaned at least 10% of its gross receipts during 2019 from sales from people dining in the dining room, and that dining room was shut down because of a government order, they would meet the nominal portion test, which means that they would have experienced a suspension of operations and are eligible for the employee retention credit. The next test that a business can meet to demonstrate that it had a suspension of operations is the nominal effect test. And I think this one is especially applicable to the home care industry. If a business can show that a government order that impacted its operations had at least a 10% effect on the business's ability to provide its goods and services, it would be considered to have a suspension of operations and would be eligible for the ERC. The example I'll use here, again, is I'll go back to the fact that a lot of these home care businesses could not send their representatives into locations where they would get referrals, such as an assisted living facility or a hospital. This, for many home care businesses, would have created a more than nominal effect on its ability to provide its goods and services. And that would create a suspension of operations and is going to make the business eligible for the ERC for the duration of the government orders that created that more than nominal effect. We'll go to the next slide real quick, and I'm just going to talk real quick about recovery startup businesses because this is kind of a specialized little niche of this law. Businesses that began operations during the pandemic after February 15 of 2020 and typically had annualized gross receipts of less than $1 million are generally automatically eligible for this credit for the third and fourth quarters of 2021 and can receive an ERC of up to $7,000 per employee that were on payroll during those 2 quarters, for a credit of up to $50,000 for each of those quarters. So again, keep that in mind. If you started a business during the pandemic, we need to talk because you might be eligible for this employee retention credit. You can go ahead and go to the next slide. We'll just talk real quick about what this means for the home care industry. We can move on again. Obviously, operating a home care business during the pandemic was not easy going. Like we discussed, you were unable to send your representatives to go see your referral sources. You were unable to send them into assisted living facilities to provide services, into hospitals to provide services. There were travel restrictions on your employees. It was obviously also very difficult to hire during the pandemic because of the increased demand on all of your potential employees. Let's go ahead and skip to the next slide, please. I do want to make mention, though, that you should take caution who you interact with when you're discussing the employee retention credit, because there are a lot of unscrupulous vendors in this space right now. As I mentioned, the employee retention credit can generate just a tremendous refundable tax credit. For some of my clients, these tax credits have literally been in the seven figures. And anytime you're out there claiming $1 million plus tax refund, it is going to attract some people that are probably a little bit more aggressive than they should be. As I mentioned here, businesses that see that, so there are vendors in this space that see that there are hurting businesses that are going to be able to claim a 6-7 figure tax credit refund, and that makes them get a bit aggressive, a bit more aggressive than they should be. There are many businesses out there that are charging fees that are stated as a percentage of the refund that a business is going to be claiming. And that misaligns the incentives of this vendor, because they are going to try to obviously claim as big a credit for this business as possible, because they're going to be charging a percentage of the credit that is to be received as their fee. And what that does is that makes it so that there are businesses in this space that, like I said, are just getting a little bit too aggressive. While this credit rather has been an incredible windfall for many of my clients, for some of my clients, they have worked with businesses that have gotten too aggressive and claimed credits that are larger than they are eligible for, and they have had to come to Frost Law to retain us to basically fix the mess that has been created by their previous vendor. Go ahead and skip to the next slide. So let me just talk very briefly about how Frost Law can help you claim the employee retention credit that you are eligible for. So like I mentioned, there are some businesses, some vendors in this space that are getting just a little bit too aggressive and bending the rules of the law to claim credits that are bigger than their clients are eligible for. I like to say that Frost Law is not necessarily on the conservative side of this industry, but we are certainly a little bit more diligent than some of our competition. Frost Law is made up of attorneys. We have over 60 attorneys on staff. We have CPAs. We have enrolled agents like myself. And combined, the tax pros at Frost Law have literally hundreds of years of experience working with the IRS. And I'll also go on to say that it's our licenses on the line. So we don't get more aggressive than we should be, because we have to protect our licenses. Licensed tax professionals are not allowed by the IRS to charge contingent fees. What that means is that we can't charge you a fee that says we're only going to get the money we're only going to get our fee if you get your refund exactly as claimed with the IRS. That is a disallowed business practice by the IRS. Licensed tax professionals also cannot charge percentage fees. What that means is that I cannot charge you a percentage of the credit that you are going to be claiming from the IRS, because, again, the IRS considers that to be a dishonest business practice. So if you have somebody out there that's telling you that you're going to get a $500,000 tax refund and we're only going to charge you 15% of the credit that you're going to be receiving, that individual is in all likelihood not a licensed tax professional, because, again, if you have a license, this is not a practice that the IRS allows. So if you are talking to a business that is quoting you a fee that is going to be a percentage of the credit that you are going to be receiving, the person that's making that quote likely doesn't have a license to protect. So just take caution. We thoroughly research all of the government restrictions that create eligibility for the businesses that we represent before we file any claims. We have an entire team of tax law clerks and tax attorneys on staff that thoroughly vet all of the government restrictions that were in place on a business before we make the determination that the business is eligible for the ERC and before we file any claims. I'll also mention that we stand behind our work 100%. Should you work with Frost Law to file a claim for the employee retention credit and your claim is later selected for audit, Frost Law will represent you and defend you against that audit, I should say, at no additional cost provided that there are no conflict of interest. Let me also tell you just real quick about how our process works. Should you be interested in exploring whether your business is eligible for the employee retention credit, Frost Law will reach out to gather some basic information from your business's operations during the pandemic, and we'll use that information to put together an estimate of the credit that your business is eligible for. Once we have that estimate ready to present, we will reach out to set up a call, provide you with the estimated credit that the business is eligible for, and at that point, we'll be able to quote you a fixed fee that we will be charging to file all the claims for the business for the employee retention credit. You can go ahead and move on to the next slide now. Now, the nitty gritty, I'll just go through this real quick because this is not the interesting stuff, but some stuff that I just like to talk about just for no other reason, you know that I know what I'm talking about. You can go ahead and skip to the next slide. How does a business claim the employee retention credit? Each one of the business owners on this call should be, at least I hope, is filing a Form 941, a payroll tax return with the IRS each quarter. The Form 941 reports the payroll taxes that the business owes to the IRS for the wages paid to its employees during that quarter. The employee retention credit is claimed on this Form 941. However, because the employee retention credit is only available during 2020 and 2021, all of these Forms 941 should have been filed at this point. So Frost Law files an amended 941 to claim the employee retention credit for the business. You can go ahead and skip to the next slide. There are some documents that the business is going to need to hold on to in case the business has its claim audited. Like I said, the Frost Law will put together a list of all of the government restrictions and mandates that impacted the business during the pandemic. The business will need to hold on to a list of all of those restrictions that were in place. Any records of decline in gross revenue, if applicable, records of the qualified wages that are paid to its employees, documentation of the eligible health plan expenses. That's another thing that I failed to mention earlier, is that employer-paid health insurance expenses are also eligible for the employee retention credit. I'll skip that next bullet point because that one gets a little bit technical. The copies of these Forms 7200. So some businesses were able to claim the employee retention credit contemporaneously on their original Form 941s, and they were even able to get an advance refund of the employee retention credit that would have been claimed on the Form 7200. You'll need to hold on to that for at least 5 years to demonstrate that you're claiming the correct amount of the credit. And you'll also need to hold on to copies of all of the federal employment tax returns, which are the Form 941. And I will repeat that the business needs to hold on to all these documents for at least 5 years because the IRS has extended the audit look-back period for all employee retention credit claims from 3 years to 5 years, mostly to give themselves a chance to catch up because we all know how slow the IRS has been since the beginning of the pandemic. You can go ahead and skip to the next slide. And I'll just address a couple of these special issues again real quick because I'm sure everybody's ready to get back to work. Aggregation rules. So that mostly means if a business owner owns multiple businesses, all of these businesses have to be treated together as a single employer when analyzing the business's eligibility for the employee retention credit. That can often work in the business owner's advantage. I'll give you an example. We have a business owner that owns a restaurant that is eligible for the employee retention credit because of all the various government restrictions that were in place on that restaurant. And this business owner also owns a construction business that would generally not otherwise be eligible for this credit. But because those businesses must be treated together as a single employer because of the common ownership, that construction business was able to claim the employee retention credit as well. New businesses, they can still be eligible. Like I said, if you started your business during the pandemic, there is a good possibility that your business may be called a recovery startup business and can be eligible for the employee retention credit for the third and fourth quarters of 2021. And it can be eligible for the employee retention credit for other reasons as well. But again, if you are a recovery startup business, you're generally automatically eligible for the third and fourth quarters for this employee retention credit. One other thing to mention, wages paid to majority owners and their majority owners and their relatives are not eligible for the credit. So if you own more than 50% of the business and your nephew is on payroll, unfortunately, wages paid to you and your nephew are not eligible for the ERC. Likewise, sole proprietor income is not eligible for the employee retention credit. This is a little bit different than how it worked for the PPP loan program. Under the PPP program, business owners could pay themselves distributions and count those distributions toward the payroll necessary to satisfy the PPP loan forgiveness. Again, unfortunately, that doesn't work that way for the employee retention credit. And then I'll just come back to this last bullet point again real quick. The IRS has expanded its time to look back and audit any employee retention credit claims to 5 years. However, they did not somehow extend the statute to claim a refund for the employee retention credit. So businesses have until April of 2024 to claim the employee retention credit for calendar year 2020 and until April of 2025 to claim the employee retention credit for calendar year 2021. So I hope that I gave you all some good information. I need a deep breath now. You can go ahead and skip to that next slide just so I can show you some of, well, you go ahead and I'll skip the questions on this. We have an old version of this slide. Excuse me. You can go ahead and skip to the end. I don't think I'll be able to take any questions right now. It looks like we're running out of time, but please do reach out by email if you have any questions that I can answer, and I'm sure that Sarah will be able to share all of our contact information.
So you guys, very valuable information. I'm learning a ton. I will be personally reaching out to you guys, but Matt, I'm curious. So what is your advice to those home care agencies? Because I've even met some that said, oh, I already talked to somebody and I don't qualify. What is your advice to those?
Have them take another look. Absolutely. 100%. And so this is something that I tell, every prospective client that I talk to really is that I'm not here to denigrate your CPA, but, CPAs are one of the most overworked professions in this country. It's always the 15th of the month, whatever month you're in. So they're always up against a deadline. And this is a special, unique niche of the tax code that most CPAs just have not had the time to explore thoroughly. So a lot of my current clients, spoke to their CPAs in the past. Their CPAs told them, well, unfortunately, you're not eligible for the credit because you didn't have a decline in revenue, just as one example. And so we've gone behind many other CPAs and other ERC firms, and in certain cases found literally millions of dollars of unclaimed employee retention credit. So it's always worth a second look. I'd say it is, I don't want to call it free money. We'll call it found money maybe. But there's a lot of money on the table, and it's always worth just at least taking a second look.
Well, imagine how many poor caregivers they can assist with employment and clients in their community they can help, right, with this money to reinvest in the business. So absolutely take another look. Jody, so my question for you, maybe it is a business, a home care company that's been around for a while, but typically, I see this with ones that are newer. Should they save every single receipt, or what exactly are the things that they need to make sure that they're doing to make it that they're actually running their business like a business and not a hobby, like when it comes to the expenses and whatnot?
Right. So, the IRS is a little bit vague. They say an expense has to be ordinary and necessary. So look at the industry. And if, the other businesses in the industry are having those types of expenses, then most likely it's going to be an allowable expense. I did have a client who was audited by the IRS. He had a lot of travel. He had a lot of meals. He did not have any receipts. And all he was able to provide were credit card statements. And the IRS disallowed all of it because they said, you don't have any receipts. You don't even have a restaurant receipt. So yeah, I can see that you went to a restaurant, but I don't know what you bought. I don't know who you met with. Like, what was your client who was there with you? And so there's some apps out right now that if you use QuickBooks, I know that there's some apps that can link to QuickBooks where you can, and QuickBooks might even do this, you can take a picture of your receipt right then and upload it. And so, that kind, like Joe was talking about, use your technology.
I needed that piece of advice right now. If you guys saw my wallet, you would be mortified. There's probably 20 receipts folded up in there. So, yes, Joe, one of you guys text me after and let me know what this technology is that I need.
Okay.
Yeah, definitely. And now you have me scared because I was thinking I could do the statements, but I know that I haven't, kept all my receipts. So that was a golden nugget right there, Jody. Thank you. And I'm sure not just for me either. So Joe, when people are, they're still doing their own books or, being the CFO in their company, what's a good triggering event or something that should make them realize they should consider outsourcing those aspects of their business?
Honestly, I mean, I feel like unless you're an accountant or unless you are familiar with accounting, you might want to look at it, because I get a lot of clients who feel like they know what they're doing. They think it's straightforward enough. QuickBooks makes things pretty user friendly, but you'd be surprised how many intricacies there really are, especially on the balance sheet. I mean, just knowing how to treat certain expenses and whether to capitalize something or whether it's a prepaid expense, if you want to smooth out your income and your expenses so that things match up in the correct periods. There's all kinds of little things there that they wouldn't be obvious to the non-experienced professional, I guess.
Well, isn't it true also that it's accounting, right? So, like CPA work, when you're talking about taxes and bookkeeping, right, is completely different than a CFO perspective, right? Because the CFO is really forward-thinking projections. Okay, here's your vision, but here's what we have to do financially. I do not know your area, so if I don't sound like I'm making sense, that's probably why. But do you understand what I'm trying to explain?
Yeah, no, that's true. I mean, CPA is a pretty broad profession, but it kind of boils down into two categories, which is assurance services and tax services. And assurance is like audit, right, financial statement work, and then tax services or tax returns, and then tax planning and consulting. But it all kind of ties together into advisory type of work. And being a CPA, you don't have to be in either of those two buckets. You can be in a public or a private company doing accounting work that those CPAs end up working with to either perform their audits or do their tax returns. So, but I feel like being a CPA, you have professional designation and experience on what those end users need. And being internal in the company, you're going to be able to keep the records and keep the books straight to make those other functions that much easier to perform. And
So I know that you have many years of industry experience, non-medical home care industry experience. How does that make you, well, just aside from the fact that you know the lingo and the language, but what is so unique about the home care industry that really makes it important to work with somebody in your capacity that understands home care?
I mean, I think it's just just it's different. It's similar to other industries in that it's based on hourly services and you're billing for those hourly services, but it's different in that there's different laws that are applicable. There's different requirements. just being familiar with the business from a margin standpoint, from a benchmarking standpoint, to be able to say, oh, your costs are high in this regard, or
Mhm.
you're doing things really efficiently in this regard. I
Because you're
think
able to recognize it,
to
right?
be able to
It's like
recognize it,
anything, you're
yeah,
able to recognize it because you've been there, right?
mhm.
Seeing it.
And to know where the key performance indices are. To know you should be looking at your unbilled overtime. That's something that may not stand out to the layman. Is you know why I'm billing this, and I know that my bill rates are twice as high as my pay rates, but I'm still not getting the profit that I think I should be. Well, what about your unbilled overtime?
Mhm,
So
mhm.
there's it's just familiarity with those types of things that I think really can bring a lot of value.
How do you, the three of you, you're all colleagues, right? And complementary with what you each do. How exactly is it that you guys are functioning in a team for home care company owners?
Okay, well, I work with Kullman Accounting, which is the sister office to Kullman CPA. And a lot of big firms nowadays are separating their tax and assurance services from their bookkeeping and consulting services. So that's what happened there between Coleman Accounting and Coleman CPA. We just split the two practices, but I mean, for all intents and purposes, it's kind of all under one name.
Okay.
And then Frost Law, as Matt was saying, because the employee retention credit is such a complex area of tax law, we outsource that function to them because they're our trusted industry experts in that field.
Makes sense. Makes sense. So, with the last couple of minutes, so one last thing from each of you. So the question is, what is the one thing you would like the audience to walk away with today, right? If anything you want them to remember, what is it? We'll go ahead and start with you, Jody.
I would like to say I've been a CPA for in public accounting for over 23 years. And I really like it when the clients take the tax return that I've prepared with my blood, sweat, and tears and really look at it because they know their business better than I will. And so when they really look at that tax return and, point out a mistake, point out an area that you want more focus on, because a lot of times I'm coming in at the end and I'm looking back on something that's already happened. Whereas Joe is in the mix in the moment. He's your outsourced CFO. So he's helping you, kind of like you were saying with the forecasting and the projection. A lot of times our clients don't necessarily want to pay for us to do a projection. So the year goes by, the year ends, and then, February 10th or so, I get the books. It's really kind of too late to do anything. So get your CPA more involved, or Kullman Accounting can handle all those in between things, when I'm not preparing the tax return. That's what I would say. Read your tax return and call Joe.
The other thing too is that the fact that we work together is we can save you some money at the end on the tax return if we're kind of getting everything prepared for that and doing everything properly so that all these adjustments and cleanup doesn't have to be done at the end.
It's efficient.
Mm-hmm.
Matt, I will be reaching out to you. What is the one thing that you really want people to walk away with today in regards to ERC?
Well, let me just first say what Joe and Jody had to say is really, really important stuff. I think the one thing to keep in mind there is you cannot tax plan in reverse. You can only tax plan looking forward. But as far as the employee retention credit is concerned, the one thing I'll say is take another look. I filed a claim last week for a retailer in my region that was in the 7 figures, and their CPA had told them that they were not eligible for the employee retention credit, and that just was not correct. So take another look. This thing has been an incredible windfall. I have never seen anything like it in during my career working in taxes. It is astounding. Just take another look.
Awesome. And Joe, bring it home.
So I think Kullman Accounting can be the point of contact here. Me specifically, if you're interested in any of these services, reach out to me and I can get you the information you need. I'd be glad to do a free consultation with anybody just on, setting up that initial meeting, giving you more information, answering any questions you might have, and then taking it from there.
Fantastic. Well, thank you very much, everyone. Incredibly valuable information. You guys clearly are experts in your respective areas. So we all appreciate your time today. And I sure do hope that anybody that had questions throughout the presentation will go ahead and reach out. And if they reach out to me, I will send them your way. So thank you. And I hope you guys enjoy the rest of your day.
Thank you so much, Sarah.
Thank you.